Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All righty, fantastic. Let's see what's going on. I can't believe, I tell you what's going on is the Dow turned positive. Look at this. Oh, well, the headline Dow is positive, the futures are not. But unbelievably, we have completely recovered from that dip this morning on the Dow. The other guys are recovering too. So that's stunning, this little turnaround here. Oil is holding up all right. Gasoline took a nice dip all the way to 182.37. I didn't get a chance to reshort it, unfortunately. I only caught the first wave down. So that's very interesting. Gold is down a bit, silver's down a bit, but 17 is a nice bouncy line there. Coffee's way down. That's nice and cheap. It's a good buy at 123.60. What else is going on? Natural gas, that went all the way through. It has to pull back a lot before we're interested in natural gas again. And so let's take a look from this morning at what we were looking for and see if we were right, okay, based on the 5% rule. So here's the post, and I wrote this about 8:30. Let's see. That was a Nasdaq play we did earlier. So actually, here's important though. So yesterday at 3 p.m., we looked at the indexes that were way up here at the time, and I said, now's a good time to start shorting. I mean, we had this dip, then we came back, but see how the dip is on decent volume, and then it comes back on lower volume, and the volume fades out. That's when you think it's probably a bullshit move. And so at this point, we said, well, you know what? If it starts breaking below these lines, we can start shorting it again. So NQ, we had this 6,700 line, this red line right here, and that was a great shorting line. So perfect. And that's why I use the NQ, because it was right off this nice line, and it turned out to be the resistance line also. So many good reasons to short it. So I accumulated a bunch of those, and I even let it ride overnight, because I was like, well, I'm like, the worst thing that happens is going to bounce back here. But I was sleeping soundly as it was having trouble even getting back over this bar overnight, before I went to bed. And then it just trailed off, and we had a great morning. So, and now it's all the way back, though. It's incredible. Now it's way back up here. Not all the way back, but actually it's right back to the bounce line, which is the important part. So then we looked at it and said, well, okay, if that's what's happening, what are we going to be watching for? So we talked about the 5% rule. This is from the Morning Post. And I said the 5% rule. So the Dow fell from 25.4, which is up here. Don't forget, this is a 5-minute chart. So the Dow fell from 25.4, which is this line up here, and it fell to 25.225. So it's 175 points. So you take 20% of the drop of the 175 is a weak bounce. And so that's going to be 35 points. So we say a 35-point week bounce is 25,260, which is this line right here. And then the strong bounce is 25,300. That's this line right here. So from here, 25,260. See how it comes over it, below it, over it, below it, and then it holds that line though. So that's kind of a bullish looking trend. The next time it blasts up to the strong bounce line, fails there initially, comes all the way back to the weak bounce line, but because the weak bounce line holds, now you say, oh, that looks like it's still on a good path then, because you had a weak bounce, didn't quite fail it, went to the strong bounce failed the first time, but the weak bounce held, so now your floor got higher. Then you go up to the strong bounce line again, you get over it, on the pullback, the strong bounce is now holding, and we're off to the races. So early on today, we knew that this was not going to be a good time to short here. Now, of course, the Dow, you have to weigh it in also, though. The Dow is the least reliable index, so that by itself doesn't convince you not to play. Okay, because any one component can throw the Dow off by a mile. On the Nasdaq, we went from 6,700 down. Notice I say ignore the spike. Here's an important point. Ignore the spike means this is the consolidation line, 6,700. You can see all these little you can see how good of a support line that was. So forget this. Who cares about that? That didn't even last long. This is, again, 5 minutes. So this is from 1 p.m. until 1:30. It was above. Then it came right back down. So for a half hour, it was over that line. And then it went right back below it. And then it tried to consolidate. So we'll call that the line. So from 6,700 to 6625. Now, we know the Nasdaq likes to move in 25s. So when we see this, we'll take that line over the other lines. I'm sorry, that's 35. It's not 25. I wonder if I got that right. Oh, I ignored that too. I'm sorry. I took the 6650 because we had consolidation there. But I was going to say, so if it went to 25, I would use that, but it didn't make it to 25. So 6650. So in that case, you're only talking about a 50-point drop. 20% of 50 points is 10 points. So 6660 is the weak bounce. And as you can see, we're kind of halted at the weak bounce, but holding it. Remember what the Dow did when it held the weak bounce? And then 6670 is a strong bounce. We haven't tested that yet. But given the way the Dow looks, I'm more inclined to say this is a good bullish bet right now than a bearish bet. And I said that this morning too. I mean, when we were down this morning at the open, back down here, and taking the money off the table on these trades, well, it was NQ especially. Where was that? So yeah, so NQ was down here. So when we took the money off the table on this trade, I said I'm more inclined to be bullish than bearish, and so far that is holding up, other than this little spike down here. The S&P 2760, way up here, and down to 2740. And that's a 20-point drop, only 20 points. And that means we're looking for 744 and 748. So 744 is right here. And again, it went to the weak bounce, failed it, held 40 again, came back up, goes over the weak bounce, and now it's making its next move to the strong bounce line of 48. So both of the thicker index, the bigger indexes, the ones that have more stuff in them that are more reliable, are both showing us a strong bounce, and they're both consolidating at the strong bounce line, while the Dow is leading us higher. But it could be just because any single stock is doing well in the Dow, so it doesn't mean as much. And the Nasdaq, by the way, could be only because Apple's doing super well, but Apple's pretty flat, so that's not why the Nasdaq's recovering. Now, the Russell, again, very jumpy index. And here we saw the fall from 1565, which is right up here, just under this line. I use that because I didn't want to use 66 because the Russell tends to hit the 5, so I didn't want to use the 66. And 70 was too much of a stretch, so I used 65. And back to 1550, which is obvious right down here. So that's a 15-point drop, and that's 3-point bounces, which is 53 over here. So what do we get? 53 and there's not much of no proof here at all. We're kind of right over it, a little below it, and right back over. And then 56 is where we did get consolidation, but it also blew higher. So now we have two indexes showing us evidence that they're heading up, and therefore on both the Russell and the S&P, I think it makes sense to play them bullishly into the close. So we're talking about, and then who's a better play? Well, we've got 748 is the line here, so that's an easy line to play. On the Nasdaq, the line is 6670. So those are the two lines we want to watch closely. Then you go back to the futures chart, and we look at who looks like a better play right now. So we've got we got the Nasdaq over there at 70, and then TF is the other one we want to look at. No, it was the S&P. Sorry, yes. So the S&P we would like to play over this 50 line bullishly, but you see this pink bar? That makes me not so much want to play because it looks like it might have some trouble getting over that. So I might want to wait to see something better, and that means I'd want to probably, if this goes over the pink bar, then I would play the Nasdaq bullish. All right, but news-wise, I don't have any particular inclination. I just read the news, in fact. I don't have any particular inclination to be bullish into the close, just that, well, we always go up into the close. That's the way the market works. But the signals are so far that a bullish play makes the most sense. So we'll see what happens. Let's see if we have any questions before I move back to the other stuff. Can't see other people's questions. That's interesting. Did see your typed answer. I'm going to raise my hand just because I can. I know there's a thing for that, but I'm certainly not looking at it. Is there an option to use a landline to dial into this seminar? That is a question for Greg. I honestly have no clue. Maybe it says something on a control panel. Audio is choppy. Okay, that's important to know. If other people are getting that, please let us know because we want to. We need to know. This is the first time we're trying this new webinar thing. So audio choppy is a problem if that's a consistent issue. Let me see. So where's my expanded control panel? Here it is. What is this telling me? Oh, click to see whose hands are raised. I don't get it. I don't know. Maybe it means something, but I don't know what it is. I'd say don't use the hand raising thing. That doesn't make any sense to me. Audio sounds perfect. I can't see anybody else's questions. Huh. Is that a good thing or a bad thing? All right, Greg, if it's possible, let's maybe try to make it so people can see other people's questions. There's no harm in that. And that seems like if two people have the same question, it might be saving trouble. But good, the question. I like the way this question box works better than the other one. The other one was a real pain in the ass. So that's a good thing. All right. So I'm going to shrink that up now. I'm going to talk some more. Okay. Very nice. I like the controls here. Ooh, see, now everybody's weakening. That's why. Although I was kind of inclined to go try along here, that pink bar put me off because that's the resistance line, and the S&P hadn't cleared it yet. And as it turns out now, everybody's failing. So that pink line on the S&P turned out to be pretty significant. And as we know, those are on the indexes that are on the bigger indexes on the Nasdaq and the S&P, both of them are hitting their strong bounce lines and failing them at the moment. So now we're turning a little bit. Now we can maybe say that the Russell and the Dow had no reason to recover like that. And here's 1561. So we'll just have to see what holds up over time. I'm not going to worry about it right now. It's not important. I was just telling you how I look at the futures. But that's why we haven't actually hit any plays since this morning. So where are we? Wednesday, no. I want to go to our portfolio. Yes, the watch list. All right. So, So I'm starting to put the portfolios together. This is our new long-term portfolio. It's not done yet. It's a lot of work putting these things in from scratch, I got to tell you. So I got up to the C's. But you know, it's you know, as usual, we've got more cash. We already have more cash than we started. But we started with $500,000. We have 510,000 already. That's because we sell puts, and we sold 3, 7, 8, and $15,000 worth of puts we sold. That's why the cash bumps up. And of course, as usual, we spend virtually nothing on our trades because we sell, you know, for everything we buy, we sell something. And we try to sell as much as we buy or more than we buy. So we have very, very low cash cost entries. Margin wise, we're using 102,000 of margin already. So we're using that 10% of our margin on 6, 7, 11 positions, which is fine though, because now if we're using 10% of our margin on 11 positions, we don't want to have 100 positions. So we're never going to use all of our margin at this pace. It was 11 positions. Maybe when we're full, we'll have 40 positions, 50 positions at most. So if 11 is using the 10th of our margin, then 50 will use half our margin. That means we're on a good pace. Okay, we don't mind using half our margin. That's okay. But we're nowhere near that now. We're at 1/10 of our margin, so we're not even, you know, there's no worries about this thing so far. And that's not portfolio margin, that's ordinary margin. So we're in good shape. What else? Okay, so those are the ones that are officially added, but more importantly, we have the watch list. So let's talk about these stocks that we were looking at. And this is not definitive because we also added some in the posts and things like that. But I'm trying to, you know, I'm starting with the watch list, and I'm going to go back and fill out from the posts which ones we had also. So Apple, we didn't officially enter yet because we were hoping for a pullback. And as you can see, it's doing a little triangle squeezy thing here. So it's going to either go up or down probably 10% on the earnings. And that's 50, you know, that's 15, 20 bucks at this point. So we could go all the way down to 150 or 155. So on the off chance that happens, I'd rather wait because I mean I'd load up at 155. ABX we did pull the trigger on Barrick Gold just in time for gold to sell off, so that's kind of a loser at the moment. But that's okay. I mean, you know, it's not. It doesn't matter much if something's up or down any particular day. In fact, let's take a look at that one, ABX. So here it is, and in fact, it is actually net. Yeah, it's minus 140 net. So it's not killing us or anything. We have the 13-20 spread with the 15 puts, and it's 2 years from now. So it's not even something you can, you know, you don't look at the trade and worry about it whether it's plus or minus. The only reason I would care at all about Barrick right now is if something actually drastically changed. In the company, like if we heard news or something happened. But the fact that gold goes up or down, or Barrick goes up or down, or whatever, who cares? We have a 2-year spread on this thing. Gold is, in fact, nope, those are days. But you know, if you look at gold, gold is actually generally strong. So I don't know why Barrick's selling off. I think it's kind of silly. If we look at ABX, I think they sell gold. That's pretty much what I heard about them. They are a gold miner. So here's the longer term chart. They're lower than they were all of last year, pretty much. And they're lower than they were most of 2016. But gold is certainly much higher. Not a little bit higher. It's much higher. It was down at 1150. Now it's 13. That's like to more than 10, like 15% more. So I don't know what people are thinking. I really don't. I mean, I gotta say this could be, well, it's not the trade of the year because we already picked the trade of the year. But I mean, when I go on BNN next week, I have a thing because usually they invite me on in November, and I tell them my trade of the year when we have a trade of the year. This time, they for whatever reason they didn't invite me in November. I came early November and told them about limited brands. And I put that in the portfolio for those guys. But then they didn't have me back at the end of November or even in December. So now I'm not coming back on until at the end of this month. And I don't know what I'm going to tell them. I mean, I have to see what's up. But this one is moving into first place, Barrick Gold, because holy crap, where's the logic to this? In the fourth quarter, it doesn't go back that far. Let's see if we can go weekly. It might not make any sense. Okay, here we go. Okay, so in the 1, 2, 3. Okay, so in the fourth quarter of 2016, the average price of gold was between here and here. So let's call it here, which was $12.50 an ounce. In Q4 of this year, the average price of gold is more like $12.75 or so. So they're getting more money per ounce for gold, running the same operation. So there's no reason to sell off there. Now, what gets really exciting, though, is when you come into Q1 again. You started off really low, and it only went up to here in Q1, so the average is up around here at $11.50, and here we are here at $12.75. That is 10% more. So in Q1, we're starting Q1 10% higher than Q1 of last year. So what's that going to do to their comps? If they're collecting another $100 and something an ounce for every ounce of gold they sell, and they're mining about the same amount of gold, and they're selling about the same amount of gold, what's it going to do to earnings? It's going to bump earnings up 10%. That's going to look exciting. I don't understand why people have to, why do people have to wait until they see the numbers to understand that it's going to be? I don't need to see the numbers. I can see it here. I know what their business is. All right, so that one's really stupid and too cheap, and I can't tell you enough how much I think people should pick that up. That's why, well, we have a nice position in the LTP. We took this decent sized position, and it's $5,000 on a $28,000 spread here, and here we spent $2,500 on a $14,000 spread. Basically the same position, just half as big for the options opportunity portfolio. And all we need is for them to go to 20. They're at 15. We want them to go to 20 to hit our number. That's how undervalued we think it is, though. We took a pretty aggressive spread on these guys. ALK is Alaskan Airline. I like those guys. Bed Bath & Beyond. They did something. BBBY. They've been drifting down. We're gonna have to wait for earnings and see what they do, but they're not this bad. In fact, take a look. Here's what I like about them. Now realize this watch list. I put a lot of time in. I mean, I'm these are the summaries, but I'm like spending ages going through all the stuff for all these stocks. So that's why I want to do this, because while it's fresh in my mind, I want to talk about all the stocks that are on our watch list. Look at this PE ratio. Now, when you see a PE ratio that good, you have to say, is that real? So it's a $3 billion market cap, and we go to the financials, and if they have a PE of 6, you expect them to be dropping $500 million to the bottom line, right? Well, look at that, right? Because 6 times 500 million is 3 billion. So they're dropping 600 million to the bottom line. Let's look quarterly. Did it fall apart? Did the business collapse? Well, this is their Christmas. And last year they were at 6. So Christmas was about not quite half of the year. So let's say it's about a third of the year is Christmas. So this would be 2/3. 75 plus 95 is 170, and 60 is 230. And so you would expect there to be, expect there to be about 200 more in Christmas. So you're going to be at 430 or 5. So yeah, basically it's probably a bit lower this year, but they're still going to pull in $500 million, and the PE is still around 6. Okay, and now let's take a look at what the analysts are projecting. The analysts are projecting, for whatever reason, this is interesting, they're projecting they're projecting steady declines. That's what's keeping the stock down. Right now, they're projecting $3 a year for 2018 versus 2017, $4.50 a share, $4.50 per $21 share. Dropping to 3 is still a PE of 7. And even if it drops to 2, which I don't really see that happening, but even if it does drop to 2, that's a low estimate. The mid estimate is 270. At 270, it's still a great buy. You're still talking about a PE below 10. Again, so when I look at different retailers, I mean, you guys don't realize it. Like I look at this watch list and you see, oh, here's Bed Bath & Beyond. I also looked at 20 others that didn't make the list because they got cut. Things don't always get cut just because they're bad, though. They get cut because Bed Bath & Beyond is way better. I've got a portfolio. You have to understand, we're building portfolios, and we're anticipating having like 20 stocks in the portfolio. Yes, and again, yes, the long-term portfolio will end up having more because it's bigger. But for the LTP and the OOP, we're looking for 20 good stocks that we want to keep for a couple of years. That means in any given sector, I really don't want more than like 3 or 4 stocks in any given sector. So I'm only going to pick 3 or 4 retailers. So as good as Bed Bath & Beyond is, I know I already like Macy's. I like Hanes brand. I like Limited brand. It's tough to make this category. So I looked at a lot of retailers who didn't make the cut. But these guys, I'm like, holy crap! How could you not own this? Where's the logic in not owning something that's drawing that much cash to the bottom line? It's a bargain. When you have a bargain, when something is clearly a superior bargain, you buy it. So that's how that one made the cut. And again, what I really like about ones like this is here we took the 1750 25 spread, 25 right there. There's nothing. We're not asking it to do much, are we? And we're going to make these massive payoffs. I didn't do the number, but it's $7,500 spread, $1,700, and there's a whatever number upside. So these are good things. BX is always a good one. I like them. And here now, we're just selling puts. Don't forget, when we sell puts, we collect the cash. And we are just saying, if it gets cheap, if it goes to 30, it's at 30. It's when we did this, it was at 33. Now it's at 34. So all we're saying here is if, wow, yeah, that happened this week. It popped way up. We're saying if it goes to 30, which would be down 10% instead of up 10%, then we will be happy to start building up a position in the stock. We'll see how long my voice holds out. I got over the flu last week, but it's still scratchy. So if it holds up, then we just keep the $4,000. If it doesn't hold up, that's what it's there for. It's because we really would like to own it if it gets cheaper. If it doesn't get cheaper, then we keep the $4,000. Expires worthless, and we'll find something else to sell puts on. Cheesecake Factory, same thing. Again, of the restaurant stocks, this one is a really nice one. I like them. I like what they're doing. And here we just sold 5. It's a fairly small position in the long-term portfolio to remind us to keep an eye on them. It says right there. And we collect $2,000. And what are we doing? We're selling July 45. So here's 45. And if it's down at what's going to net out to us to be $43, which is down here, if we can pick it up down here, we'll be happy to start a serious position in Cheesecake Factory because we don't think it's going to go lower than 40. So if it does get down to here, we'll probably roll the puts, double down, and add a bulk call spread, and then we'll have an aggressive position. But for now, we're keeping an eye on it. Chicago Bridge and Iron in the long-term portfolio. This one popped also. And here we're just sort of taking a position for, we're looking for 25, and it's at 20 now. So we're looking for a pop. Hopefully the infrastructure bill comes in and we actually get a nice pop. I think infrastructure is so badly needed, it's hard to get away from it here. CDE is another miner, gets no respect, as I said here. They're I don't understand how people read things, because they just announced record production numbers. The price of gold is up. They're going to make more money per ounce. Everything is more, they're in a turnaround mode. Everything's going well for these guys. I think this is going to be a nice home run. And they're all the way down here, which I thought was like again, it gets to be a silly price. And we can take the 710 spread. So we're betting it's going to go back up to here in 2 years, mind you. In 2 years, we're betting it's going to go back up to there. But we're taking these things for, we're paying net $850 for $6,000 spread. And anything over 7, we start making money. Actually, anything over 740, we start making money. So it's all profit for us, anything going up from there. And if not, it's a very cheap miner to own. We're only going to own 1,000 shares at $7. That's our worst case scenario. Owning 1,000 shares at $7 plus the 850 is 785. So our worst case is owning the stock at about the current price. And our best case is we're going to make $6,000 or $5,150. Here's Chesapeake. Again, it's a nice way to play natural gas. It's a long-term thing. It's you're playing natural gas, you're playing shale. So I like these guys also. I think they're also very undervalued down here. They've been consolidating down at this level, and now they're getting over the declining line here. So hopefully they can consolidate above it now and start moving forward. But that's going to be based on natural gas prices and so on and so forth. But didn't we just, again, they sell natural gas. Okay, so now we look at natural gas. And we look at last year. Well, we had a spike last year. So they're not going to have the best comps for this quarter, because last year we had better pricing. Last year we were up, this quarter in particular, where's this line? Here's the line. So they probably averaged about here last year. It's a little bit lower this year. The average is below this line. And we averaged above the line last year. So Q4, not going to have the best comps. But now, since we're steadying up around here, though, we're probably going to come in about the same. So also Q1 is going to be tough comps. But after that, it's going to steady out. And if gas starts going up like we expect it to, this thing's going to have, we expect to see this. And if we start getting that, this thing's going to go through the roof. And in fact, let's see what CHK did in 2013 and 14, if we can get that. Not there. We'd have to go to Yahoo. CHK. Chart. New. Well, so you see what kind of ramp up it did when we had that good time of gas from 2012 into 2013. It basically doubled. It went from 15 to $30. All right, so here we're looking for it to go from 4 to 8. I don't think we're asking too much. I think actually 7 is the number we settled on. No, I'm sorry. We're looking for 5. We're being super conservative. We're only looking for $5 to make this money, and we're paying net $500 for a $10,000 spread. So anything above 350, we start making money, and they're currently at 4. So again, we don't need to run away. That's a great way to set up your trades. We don't need them to be runaway successes. We just need them to do decently. And we're going to make a good amount of money because of the leverage we're taking. Questions? Let's see. On the question box says, ask staff a question to make sense. We can't see each other's. Ask staff a question. No, I don't know. I think it would be good if everybody could see each other's questions, though. All right. Anyway, not important. What is the difference between portfolio margin and normal margin? Portfolio margin is something that the broker should explain this to you more so than I could. But ordinary margin is whatever calculation they use. Portfolio margin takes into account your entire portfolio. So if you have like a bull call spread, which we like to do, and you know, let's say you have a $10,000 bull call spread that pays $10,000 if it's successful, and then you sell a short call against it. With ordinary margin, they wouldn't count the $10,000 gain from the bull call spread as covering your short calls. But with portfolio margin, they say, oh, you've got $10,000 of coverage in case it goes up because your bull call spread will be in the money before you have to pay the short calls off. So it does that, and it offsets the calls to the puts, and it takes things that are similar and lumps them. You know, the broker would have to tell you exactly how it works, but the bottom line is it gives you a lot more margin flexibility and generally tends to ask for lower margin rates because it's based on you having at least $100,000 in your portfolio, but it drastically lowers your margin requirements. PBI for the watch list. Not sure. I had to take another look at them. I did like them, and I had to see how I feel about them in 2018. I think the problem with miners is everyone is focused on Bitcoin. Yeah, I do think that's keeping gold and silver down somewhat. So I agree with that, James. I think that the kind of people who invest in gold and silver are also the kind of people who are buying, not necessarily Bitcoin, but cryptocurrencies. SCO, Charlie says, SCO position question. Originally, I sold $35 puts combined with a bull call spread that went against us. I ended up rolling to April 2018 with $29 puts and adjusted the spread. Oil does not cooperate, so now looking at the third roll, I suggested rolling out to 2019 $25 puts. Oh boy, let's see. Whoop. Damn it. Okay. I suggested rolling out to 2019 $25 puts. Okay, so that would be a long-term play at a cost of $1,000. I fully intend on making this roll. My main question, what your advice for the current April 27.35 bull call spread? It looks like I can just sell the 27s to fund the roll, leaving with just the January short puts. I guess the other option is rolling the spread forward as well. Costs a little more, but will provide some upside if oil finally did crack lower. Okay, no, your thinking is correct. Damn it. Just make sure, SCO this is. Oops. I guess I should just, hang on. So SCO. You just got to make sure, though, because you're going to leave, I'm sorry, you've got the 27.35 bull call spread. So you have the April 27.35 spread. That's way up here. So really just make sure that if you start coming up past 25, that you do something like cover the short April puts. Because, yeah, I agree with your logic. Those 35s are almost certainly going to expire worthless. They're way the hell up here, and you've only got 3 months. So it's not that likely oil is going to completely collapse over the next 3 months. So this seems like a very safe place to leave a naked short. Just if you get over 25, you might want to cover with like a January bull call spread to cover. That's all. So just to keep yourself safe. As to the 25 puts, though, I think that's a good price. I mean, unless oil is going up to 70 or 80, I think eventually it'll come back to normal. NAK puts and calls are not filling at the suggested prices. You have to remind call mid price is 6 and the mid price is 80. Okay, that's an important one. So NAK, what were we looking for? I don't remember. When did we do that? Does anybody remember? Seeking alpha. Hang on, let me make that smaller. Go to Seeking Alpha. Hopefully I'm signed in. Sign in. Oh, I don't know. Shit. Why doesn't it know who I am? All right, I have to look at it a different way. The problem with having different passwords on different stuff is you don't remember what the hell your password is. I can't even see where we did it. All righty, let's try it this way. Okay. Our trade idea for NAK was trade all products NAK. Whoops. That was totally weird. NAK. All right. So what were we trying to do? We were trying to buy it for 174, well, that's easy because it's at 170 now. And we wanted to sell 50 of the what? We want to sell 50 of the $2 puts, the 2020s, $2 puts, for how much money? For $1. Ah, here's where the problem is. Okay. So these have a bid 2.95, so that's not quite $1 yet. And the last sale was 82. So the stock, easy to buy for the price we wanted. The puts not selling. And the short calls, we wanted to collect 70 cents for the 250 calls. And these are not quite 70 cents yet. So neither one of these is filling yet. Well, that's weird. Look at the $2 calls are lower than the 250 calls. That's pretty stupid. So the pricing doesn't really make any sense at the moment. There's nothing to do. I mean, basically, we're generally bullish on the stock. I mean, look, all you do is you basically make the offer. So I'm willing to sell single. I'm willing to sell 50 of the 2020 $2 puts for $1. And I put it in and I say that will be good to cancel. Wait, no, I'm sorry. It's a limit order. It's good until it cancels. And I put it in. That's all. And it tells me it's going to use $6,000 of buying power and blah, blah, blah. So that's it. And then you just punch it in. If it fills, it fills. If it doesn't fill, how does it hurt me? Doesn't change anything. I'm still bullish on NAK. So I own the stock. If somebody wants to promise to sell me the calls for net, if someone wants to promise to sell me another 5,000 shares for a net of $1, I'll take the $5,000 in exchange for that promise to buy it. But if not, I just don't get it. I just don't fill it. No big deal. It doesn't change the stock trade I have. And then meanwhile, the same goes for the calls. I don't want to sell these calls unless I get 70 cents for them. Was that the number we looked at? I want 70 cents for the 250 calls. If I can't get 70 cents, I'm not going to sell the calls. So it's the same thing. I click on it. I say I'm willing to sell them single. The 250 calls, I'm willing. Now I own the stock, so I can't possibly be hurt by this. I say I'm going to sell the NAKs, and I'm going to sell them for 70 cents. Boom. And it's good until canceled. So at some point, if it pops up. Now, if I never sell the puts, what do I have? I have a 175 minus 70 entry is a 105 entry, and I get called away 250 with an 80-cent profit, so about a 50% profit. So my worst case, if I fill the call side only, is that I'm going to get called away with a 50% profit at 250 if it works out. My worst case, if I never fill anything, which would mean it's not likely I don't fill anything, right? Because if the stock's either going to go up or down, if it goes up, this is going to fill. If it goes down, this is going to fill. It's not going to go neither. If it stays flat at 170 for the next 2 years, yeah, maybe. But one of these guys is going to fill. I don't care which one fills. I'm happy with either one because I'm willing to buy more for $1, which would drop my net to 80 cents on 10,000 of them. Or, so if it goes down, I've got a net, if it goes down, I collect $1, so I'm in for net 75 on 1,000, and I could be assigned another batch at 2, which would give me $2.75, so my net would be $1.30, so my net would be like $1.38. So if it goes lower and I sell these and I get assigned, I'm down to $1.38 on 10,000. If it goes up, maybe I'll never fill my short puts, but then this will fill, and again I get called away with a 50% profit. There's nothing bad that happens to me by not filling. So the only thing I can really do is just be patient and wait until it fills. But that's all. There's nothing bad about it not filling. You don't have to rush it. You don't have to force it. And you certainly don't have to panic about it. There's nothing to it. It's just an open thing that we're still trying to fill. I wouldn't change it. There's no reason to change it. How do we manage LTP risk in case we have a Y2K type market implosion? I'm thinking stocks like BBY and whatever. Well, you know, A is not likely. B, as we have more positions, we have very few positions right now. So here's the thing. And this is something people don't realize about portfolios. If we have 90% cash, then the cash is our hedge in the portfolio. In other words, if we're because right now we're about 90% cash in the portfolio. If we're 90% cash, it doesn't make sense to hedge because we're not risking that much. Because if the market drops 50%, let's say tomorrow you wake up, the market's down 50%. So fine, your trades will be down. Your 10% trades will be down 50%. Maybe they'll be down 100%. Maybe you'll be negative. Whatever though, but that's only 10% of your portfolio. Meanwhile, you still have 90% of your money in cash, and you can use that to buy a lot of stock at 50% off. So there's nothing bad there. So you don't have risk when you have a when you have a lot of cash in your portfolio. You don't have a lot of risk. Once we get past like 70%, once we go below 70% cash, then we start wanting to hedge. And then we hedge the risk. Earlier this week, I put up an SQQ trade for the options opportunity portfolio. We're hedging the risk over there. So you want to hedge against something like that, but it's, again, you just, as a rule of thumb, I try to put about 1/3 of the profits into hedges. We don't have any profits yet, so I'm not going to put anything into hedges on the long-term portfolio. Let's see. How can you sell a call against a bull call spread? The upper leg of the bull call spread is already sold, so you're essentially selling a naked call. Selling more calls is just selling naked calls against nothing. No, you're not missing anything. You're selling calls against you're selling naked calls, but you have coverage because you're going to make money on your bull call spread. So it's not naked. And again, that goes back to the whole what's portfolio margin kind of thing. In a non-portfolio margin account, the broker considers it a naked call. In a portfolio margin account, the broker sensibly considers it covered because it is being covered by the bull call spread or by the potential upside of the bull call spread. So we do that all the time. And then if you sell a put as well as a naked call, those two offset themselves margin-wise also. Thoughts on VRX for 2020 play, new CEO. That's a huge mess. To me, I don't know. It sounds interesting, but I don't trust them, and I don't have any burning need to be in them. And they've already made obviously they've already doubled up. So why do I need to chase it? It might be interesting as a recovery play. It's just not the kind of thing I'm really interested in playing. And I don't think last time I looked, I didn't like something about the numbers. I remember that. Let me take a look. VRX. Well, okay, I know what I didn't like. So last year they lost $2.4 billion. This year they seem to be recovering. Okay, so those guys cancel out. And here you've got 1.3 billion, which is very nice, dropping in the bottom line. But you see this negative, that's with minus 1.7 billion income tax. That's going to go away. In reality, the operating income was pretty much nothing. It's only this tax thing that made them look good. So I'm not altogether comfortable with where they are and what they're doing, and it was practically a criminal operation before. So you're betting they're all reformed and everything's fine now and there's no problems, and probably they are. Probably all the issues have been aired out at this point, but it's just not that. I don't know. I don't see any compelling reason to play them. And price wise, they're at $8 billion. So you're paying $8 billion, and before this crap happened in 2014, they only made $1 billion, $750. So, and again, that's not bad. Sorry, that's not bad, but they're jumping up. They jumped up enough where it's not like I can't keep my hands off it kind of thing. Now, I was pro this stock when it was at 10 or around 10. Yeah, it was 10. Down here last year, I was like, yeah, it's worth the toss. Down that low, it's more than double that now. So yeah, I'm not saying it's not going to go to 30. Maybe it'll go to 40 because that's where you're going to PE around 20, assuming they get their earnings back in line where they used to be. But I don't see it being a super duper home run above that. And I'm certainly not saying I'm not saying not to play it. I'm just saying it's not something I'm particularly in love with. But it's probably a solid play still. It's probably still worth it. It's just if it hadn't been at 10, I'd be more interested in it. But since it was at 10, I'd prefer to see it. I'd prefer to see them stumble and come back to 15-ish and then pick them up, assuming that there was a good reason to do that. Oh, you were giving me the thing. Yeah, I think I went over it correctly there, right? Sell the $2, puts for $1, right? So, like I said, just put the offers out there. They fill. You got the stock. That was easy to buy. And the rest, you see what happens. We only got, there's only 23 months left. So, and also let's keep this in mind. Also with NAK, is look at the actual range of this stock. So the only way that neither one's going to fill is if it stays here for 2 years without moving up or down. But if it goes down, you're going to fill the puts. If it goes up, you're going to fill the calls. And and so far you've been waiting this long. So, and David says, God, it makes perfect sense. So the hedges come later, right? Yeah. Yeah, it's one of the reasons I like to run these long-term portfolios. I want people to understand, you gotta learn to relax about these things. It's not that, a lot of the stuff is just not as big a deal as you think it is because everybody's got such a day trading, get everything now kind of mentality. Whereas, you're not in a hurry with these positions. They don't control you. You control them. But you need to focus on what you're trying to accomplish and not do something silly like betting against yourself. Like if you want to pick up a conservative position on a stock and you sell the puts and you buy the calls, now you're very, very bullish, right? Because now anything down is killing you if you haven't sold the short calls. That would put more of an onus on the short calls. With NAK, we're not terribly worried about downside because, like I said, the worst case downside is we own 10,000 shares at $1.35. So for 13,500, our worst case is only 13,500 worth of NAK. It's not the worst downside. So we're not terribly worried about filling the calls. Now, if it was Apple though, and we had 1,000 shares of Apple for, well, we wouldn't have 1,000 shares. If we had 500 shares of Apple for $100, it's $50,000, right? And we sold the puts. So let's say we sold 5 puts also. Now we've got a very, very large Apple position potentially that could be assigned to us. But we didn't sell any short calls. So now we're just being silly. Now we're being needlessly optimistic about a stock. So you have to think in terms of what do you really want to try to accomplish? And if you're not comfortable with it, then pull back or whatever. So in other words, if you weren't comfortable with owning 10,000 shares of NAK, then you would wait to sell the puts until after you fill the short calls. You wouldn't do it all. You don't want to do it all at once, or you only sell some of the puts and wait and see what happens with the short calls because you don't want to overexpose. Either way, but that's the important thing: is always try to focus on what it is you wanted to do in the first place and how comfortable you feel about the position you're in at the moment. All right, we'll get back to this thing in a minute. Let's take a look at how the futures are doing. Okay, everybody is creeping up a little bit. See, that would have been a good long play. Well, we're still having trouble right at that pink line, though, but we're right on it. He wants to pop it, but he's not doing it. Still kind of drifting along the same place. So nothing too exciting going on here. All right, that's boring. But I still can't believe, look at the Dow, it's right back. Everybody's right back. Everybody's back. And the Russell's green. Unbelievable. This market is insane. All right, so back to the list. All right, Chimera. Ooh. Yeah, I was just saying to myself this morning, if they come back to this line, I want to pull the trigger, and apparently they touched it today. The rising rates scare people out of REITs, and that's what we want to take advantage of. So we'll keep an eye on it, but this is like an entry on Chimera. It's hard for me to not buy them at this price because they pay a really fat dividend. They're a well-managed company, and they can handle rising rates. Their management's good. They know what they're doing as far as juggling their loans. Cleveland Cliffs, another one that's going to benefit from infrastructure and also from tariffs. So they've got the tariff thing going for them. They've got the infrastructure thing going for them. And here in the long-term portfolio, again, it seems aggressive because we're selling the $10 puts, but we're selling $10 puts for $370. So 10 minus 370 is 630, which is here. That's our net entry, is where this bottom is. So even though we sell the $10 puts, we're netting in for 630, and everything above 630 is profit. And that's not even a full position. That's just a watching position. Because what's the worst thing that happens? We get assigned at 630, 2,000 shares. That's like $12,000, which is a nothing position in the long-term portfolio. So we would be happy from there to double down and add a bull call spread and do all kinds of fun stuff. So even though we're collecting $7,400, it's just a watch position. But hey. If we can find one of these every month, we'll never have to trade anything. We can just sell puts every month if we can find enough of those. Energy Transfer Equity. This is another natural gas play, but they didn't make the cut so far. We were hoping they go lower. Ford. Ooh, Ford got in trouble today. Apparently, they cheated on their emissions just like everybody else. You know what? It's amazing to me because if you think about, think about how horrifyingly dishonest corporations are. That pretty much every single car company, they cheated. I mean, they go to the extent where they program their cars' computers to cheat on the emissions tests. Because the car knows when it's being tested. This is generally how they do it. The car knows when it's being tested. It has a test mode. And why does it have a test mode? Because the emissions people, when they pass the laws saying how they're going to test cars, the car companies buy off the politicians and have the language written in the laws to car testing that says the car will have a computer mode, so it will have a testing mode so that we can run a test uniformly. And why do they want uniform testing? They want uniform testing because you say, oh, wouldn't they not want to be tested? Well, they know they're going to get tested. They can't stop that. But they can then control the test environment. And so they make it so there's a uniform test. Excuse me. They make it so there's a uniform test, and then they cheat on the test. So they go to the extent of bribing politicians, passing laws, creating a test, cheating on the test, creating computer programs that specifically cheat on the test, all so that they can pollute the environment with cancer-causing materials that are destroying the atmosphere. Okay, this is like supervillain evil stuff that essentially every single car company in the world has been engaged in. And yet all they do is get like tiny slaps on the wrist. It's like, oh, you totally cheated. Millions of people are dying. Who cares? I mean, it's insane. It is absolutely nuts. I mean, these guys are to a very large extent are causing some of the global warming problem. I heard the Fords are putting out 50 times more pollution than they're supposed to. 50 times. Every Ford car. So they sell, think about that. They sell 1 million cars that are cheating on the pollution, and that's putting out as much pollution. Those 1 million cars are putting out as much pollution as 50 million other cars. You think that doesn't actually damage the planet? They should be shot. They should literally be taken out of their offices, dragged on the streets, and shot. End of story. Maybe that'll stop people in the future. They've committed crimes against humanity. So meanwhile, we love them as an investment. Because the reality is no one's going to punish them. Nothing's going to happen. They're going to do it again next time. It's never going to stop. So we added plays to Ford on 1-2, and it was down here on 1-2, and now it's up here, even with the pullback. This is all the pullback they get for lying, cheating, and murdering. It's really insane. FNSR, we like these guys with this nice telecom play. They're consolidating down here. Good company. We like them. In fact, we like them enough as a solid player. We're only playing to 25. Again, we're very conservative with our entries. We only even get to 25. That doesn't seem very hard in 2 years. But at 25, we're going to make a huge amount of money. We have 1,000% upside. And here we have a 400% upside. So we're willing to lay out a good amount of money because it's going to give us a fantastic return. $5,600 in cash is going to return $24,400 in profit. And here, $800 in cash is going to give us $9,000 in profit. And we're actually more aggressive in the, again, because we have more cash in the options, in the long-term portfolio, we have much, much more cash. So we would rather throw it down here to get 24,000. In the options opportunity portfolio, we're just playing it like a regular, conservative little play that we're in. So we got much more aggressive in the long-term portfolio on the same trade, but very similar setups either way. Just requesting the quantities. Frontier. Okay, another one here. I can't resist these guns. Also, super cheap, ridiculous. They might go bankrupt. Everybody's playing them like they're going to go bankrupt. But they also, at the moment, they're still paying an incredible dividend. Their dividend is $2.40 per $7.16 share. So the dividend is about 30%. and they haven't cut it yet. And even if they cut it in half, it's still 15%. So God bless them if they cut them in half, because I'll still like them. And here we sold the calls, we sell the puts, we drive out our look at the net. We sell the $8, we buy it for $7, sell the $8 calls and the $8 puts for $5.25. So we're netting in for $2. We get called away at $8. We're collecting a $2.40 dividend. So the entire amount of money we're laying out, we get paid back in the first year if the dividends keep up. Next year, we get 100% profit from the dividend. This is the kind of stock you want to own for your entire life if they can keep paying like this. And they might, because the dividend seems outrageous now, but what's really outrageous with Frontier is how low the stock is for no particularly good reason. That's what's outrageous, not the dividend they're paying. These guys can't understand why people hate their stock so much. And yes, they have a lot of debt, but they have a lot of debt for a good reason. They bought a huge amount of capacity and bought new customers and things. The kind of things they bought the stuff they make money on. People go into debt all the time to expand their business, but for some reason, when a telco company does it, people lose their freaking mind, as if it's like a totally bad idea. And look, only time will tell. Maybe it is a totally bad idea. Maybe they go bankrupt. But if they don't go bankrupt, you will thank me for the rest of your life for owning this stock. Because when it normalizes, and if these revenues start to actually pay off over time, over decades, that dividend can go up from $2.50 to $5. And if they're paying $5 a share back on your $2 investment for the rest of your life, imagine getting 250% a year in dividends. That's what could happen with this stock if it goes well. So that reward is worth quite a bit of risk. And what's the risk that we're taking here? The risk we're taking in the OOP. We already added this on half as such. The hell's that mean? Oh, on 1-2, not on half. We added them on 1-2. So on the second, we took 2,500 shares of Frontier, and we sold the $8 puts. So we're in for $47.75, and then if we get assigned another 2,500, so we have 2,500, we can get assigned another 2,500 for $8, which would be $10,000 more dollars, I think. Now, wait a minute, 25 times 8 is $20,000. So we can end up spending $24,000 total dollars, and we'd have 5,000 shares of Frontier. That's our worst case scenario: is spending $24,000, spending $25,000 to have 5,000 shares of Frontier. So about $5 a share is our worst case. And if they're paying $1 dividend, it's still worth owning. So it's only really a problem if they go bankrupt. But meanwhile, long before they go bankrupt, when they're at $4 a share or something like that, we're spending $5 a share total. Even if we get assigned, they go down to $3 a share. We get out. We're going to lose $2 times 5,000 shares is $10,000. So we're risking $10,000. We're not risking $25,000. We're not going to ride them out until they go bankrupt. But if things start turning sour, we'll take a $10,000 hit. But like I said, the upside on this thing is the dividend is $10,000 a year for your whole life, forever. This is like one of those lottery tickets where it like pays you for life some incredible amount of money, like what is it, $5,000 a week for life or something like that? Some lottery ticket gives you. This is like that. I mean, if you're putting up this money, and for the rest of your life, you may get back more money than you put in every single year for this stock, like 100% dividend, 200% dividend. How could you not like that? It's worth the risk. GCI, I don't know why I put GCI in here. I think it was just happened to be in the portfolio. It got away, so we wouldn't play this unless it pulled back significantly. And then if it pulled back that significantly, I'd have to wonder what the hell went wrong. GE, okay, silly. In fact, Warren Buffett just said that today. He was on CNBC, and they said, well, they said, what do you think is a good value? He's like, oh, GE, geez. It's free, and he said the same thing I said. He said, it's freaking GE. Why do I have to explain to you why you should buy GE? It's GE. That's why you should buy it. And yeah, we're both old, and we both probably have a vision of GE that's not current. But look, GE cut and cut and cut all their divisions. They spun things off. They did all this stuff. Bottom line is they have a ton of cash. They've got their three favorite divisions. They've got biotech, aircraft, and I forgot. Wait. They got the aerospace. They're doing the aircraft engines and stuff like that. They got biotech, and I forgot what the third one is. Oh, well, whatever. And they got something else that's good. So they cut themselves down to three divisions, which I can remember two of, which is like that Rick Perry thing. I'm really liking. Did I not say it here? No, I didn't. Okay, anyway. Now it's going to bother me all day. And again, we're just committing ourselves to buying a bunch of GE. We're paying $6,200 for a $20,000 spread. And part of this is the confidence. The chance that GE is not going to go bankrupt. So we can afford to put down, we can afford to puff up our chests and say, yeah, I'll own 1,000 shares of GE for $20 in the options. It's a $20,000. So I'll own $20,000 worth of GE in the $100,000 options opportunity portfolio. Why? Because there's no fear to that. Because it's not going to go to zero. Although you're allocating $20,000, you're saying, yeah, I'm willing to buy $20,000 worth of GE. You're not going to lose $20,000. It'll be worth something. They're not in danger of going bankrupt. These guys aren't even leveraged or anything like that. They don't even have any debt. They got cash overseas. They're going to be repatriating. So this is a crazy cheap stock. Great way to invest in the future. Good for industrialization. And then, of course, the aircraft cycle. GE makes engines for Boeing. Boeing has back orders for the next 15 years. They're completely at full capacity for 15 years going forward making planes with GE engines. So just that right there. And the other big thing for them is the biotech, which of course is obviously the future, is all these robot physicians and things like that and remote things. They're all into that stuff too. So they're focused on what they always focus on, which is the future. And it's a great company. So I endorse this trade with all my heart and soul. Gilead, we always like Gilead. They got a little bit expensive. Well, not really expensive, but I mean, they got more than what we paid for them last time. But I say, screw that. We liked it last time when we got them at 65. So now I'm saying, okay, we'll buy them again at 65 and we'll sell the $65 puts for $8.10. And, I don't know if we did that officially. No, I'm sorry, that's not, well, you can sell the 20. This was not an official trade. I thought it was. That's a mistake. That should have been a trade for the long-term portfolio. I have to look at that again and see if we can still get it. Oh, man of myself. Oh, I see. I see. Probably that was the original trade on 217 when we started playing Gilead. Now it's probably you can't get that price, and that's why they make it official. GNC. Again, they're probably not going to go bankrupt. Maybe they go bankrupt. Meanwhile, though, all we're going to do is say, look, we'll buy 2,000. We'll sell 20 of the $5 puts up here for $3.10. So our net is $190. Here's 4, 3, 2. So down around here is our entry. And meanwhile, we're going to collect $6,000 for promising to buy 2,000 shares at $190. So our big risk is owning $4,000 worth of GNC. But we're getting paid $6,200 to promise to do that. It's crazy. GoPro. Ooh, good timing on these guys. We jumped on, and they're still going down, but we jumped in them here and they hit $6, so we'll see what happens. But I do like this. Again, we sold 20 of the puts. We sold the $8 puts for $3.75, which nets us in for $4.25, way down here. That's our net entry. So again, even the options opportunity, we're committing to buying 1,000 at $4.25. We're committing to buy $4,250 worth of GoPro. We're getting paid $3,750 to do it. It's very, very simple to make these decisions. H&R Block, always like them when they get cheap. They're not cheap now, so we don't like them, but when they get cheap again, we'll like them again. IMAX, they got beaten up, and we love that, so we jumped on them again. And they're still coming down, but absolutely love this trade. Oh, I even wrote here, coming up this year, Maze Runner, Black Panther, Tomb Raider, Pacific Rim, Ready Player One. There's a dozen movies here, at least once a month. There's a movie that you got to think is good for $100 million. Which one of these is not going to make $100 million? Maze Runner, Black Panther, Tomb Raider, Pacific Rim, Ready Player One, Avengers, Han Solo. Even if it sucks to make $100 million. Deadpool, Incredibles, Jurassic World, Ant-Man, Mission Impossible, Alpha looks really cool. It's got the wolf, Venom, X-Men, Fantastic Beasts, Spider-Man, Aquaman. Maybe Aquaman. No, even Aquaman. How's it going to possibly not make $100 million? So that is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, and it's not every IMAX movie. That's just 18 IMAX movies in 12 months that will do $100 million. And I'm mentioning the in-betweeners or whatever. And it doesn't do $100 million at IMAX, but conceptually I'm saying a movie that does well with a lot of people going to see it. So, again, how do you not consider this a good thing? This is coming off what, by the way, was the worst box office year in a decade. So we're virtually guaranteed to do better than last year. So there's just no reason not to do this. And here we're spending $1,500 on a $7,500 spread. Here we're spending $1,350 on a $5,000 spread. And all it has to do is get to 26 back here by June. So after the first half of the year, we're expecting people to realize, hey, you know what? This is pretty good. The movies are doing good this year. LB was our stock of the year pick in November. Oh, no, I'm sorry. LB didn't know. I'm sorry. LB had popped up from here. We picked it as a stock of the year. I was on BNN here, and we did use it for our stock of the year. But by the time it got to November, they jumped up again. So we switched to Haynes, which actually isn't on this list. I didn't get to them yet. So we switched to Haynes, and now LB's come back down. If it comes back down about $5 more, I would jump all over it again. But right now it's just a no play. That's just the old play. Macy's, we like Macy's. But this is old, so it already took off, so we aren't making it a new play. We already took our money on this one. We cashed out over here. We bought them down here, and we cashed out up here when we cashed out our portfolio. Now it's right back where we cashed out. We're fine. We're not touching it. NLY is the same company as CIM, same management, same everything like them too. PSA, Public Storage, we like these guys, and they've come down a lot. So we're kind of looking at we might make a play on these guys down here. It's hard on $200 stock. You can't do it in the options opportunity portfolio. It has to be only in the LTP because you can't risk the assignment in the options opportunity portfolio. But I do like these guys. SKT is another mall. They're a mall operator. I like these guys a lot. They're pretty cheap. We might turn it into a play. SunPower. What about SunPower? Oh, SunPower. Yeah, we put this in the options opportunity portfolio. This is great solar play. Good, steady, solid solar play. They make the money actually building the panels. They don't give a crap who buys them. They're building the panels. And what I like about them right now, as far as a catalyst, is they've always sold the best and most efficient panels on the market. And there's, so they're like the Rolls Royce of solar panels. Still are. Nobody makes a panel better than SunPower still, but they never sold a cheaper market. Now, thanks to tariffs and stuff like that, they've said, oh, you know what? Let's make some cheap panels too. So now they're making very cheap panels that compete with the Chinese. But because they're SunPower, they're still more efficient than the Chinese panels. So they're giving you a cheaper product that's more efficient than the Chinese solar panels, and there won't be tariffs. So I'm looking for, again, sometimes I don't understand why. Why would people not be snapping these guys up? So we snapped them up. We picked up on the LTP and the OOP. We'll see what happens. Target's an old play. They totally taken off, so they're out. THC, we did. We just added THC. Tenant Healthcare. It's a long-term play. People get old, they get sick. The hospitals will do well. They've got a rough transition with the Obamacare stuff, but it'll work itself out most likely. Here's good old Wheaton Precious Metals. That's our trade from. Oh no, it's a new one. So we had them last year. It was the trade of the year. Last year we already cleared that out. We hit our goal. Here we're just selling 10 of the 22.50 puts for $4, puts us back in for what, 18.50 down here. So we like him enough where we're certainly willing to say we'll buy 1,000 for 18.50, and we'll see what happens. But meanwhile, we're just going to put 4,000 bucks in our pocket and see while we wait. Whirlpool, also another tariff play. They start putting tariffs on overseas machines, and it makes Whirlpool more competitive here. There's more people have jobs. The jobs minimum wage is going up, so you can expect hopefully a little bit more durable goods buying. People get a little more confident, and they'll start putting in new washers and things like that. So I like this play, and again, it's a watchy kind of play. But basically, we're saying, look, it's a 166 now. We're going to promise that in 2020 we'll buy it for 130 bucks, and we're going to get paid 11.20 to do it. So we're netting in for 118 something. Why 118 is here? It's like way down here. Why would we not do this? Some of these things are almost comical. You see some of these trades, you're like, why would I not do that? How could I hate Whirlpool so much that even if they go all the way down to 118, I don't want them? That makes no sense. So then why would I not take 5,600 bucks? So I'll get paid $5,600 to promise to buy him for 130. Makes sense to me. All right, got through that. So those are our watch lists so far. We're not done, but that's where we are. Wind turbines. Oh, thank you. Yes. Renewable energy projects. That's the other thing they do. Thanks, John Luke. Now I feel better. I knew it was something I liked. Are we still comfortable with the optical? I like FNSR was the one I decided to go with. I like them long term. I think they're solid. So we're going to go with that and see how it goes. Again, it's not the kind of thing I want to put too much in one basket, but I like it. Okay, the wind. Well, that makes me like GE much more. So now I'm going to double down and say, buy that GE. Freaking fantastic. Market selling off. Oh no, we're missing it. What's happening? Oh wow. Look at that. I don't know. I think people are starting to wake up and get a little worried. Where in the financial statements do you see how much debt a company has? Oh, that's easy. Come on. Financials, balance sheet. Who is this? I can't see because okay, there we go. Valen. Okay. So yeah, debt. So current liabilities, accounts payable, not that important. Here you go. Long-term debt, $30 billion of long-term debt. Other liabilities, deferred liabilities. Always worry about those things. Deferred liability, liabilities are liabilities. So they got that and that. And with payables, I don't worry about payables unless they seem weird. So you want to see if payables and receivables kind of balance out, it's okay. What you don't want to see, though, is you don't want to see payables ramping up while receivables are not ramping up. That indicates a problem. Sears was famous for that. Like they let their they let their payables fly. And meanwhile, they're like, it's like, dudes, you're not like selling more stuff. You're just basically running your debt through your payables. That's a very, very bad way to do business. And in fact, Sears, that's one of the things that put a nail in their coffin last year, is their suppliers started saying, you know what, dudes, we're not giving you stuff anymore because you don't pay us. It's like, if you're not going to pay us, what's the point? It's very hard. Those of you, if you haven't run a business, you don't realize how you get into this trap. But if you're a supplier to somebody and you've got a big customer and they don't pay you, it's like a trap, because by the time they don't pay you and you realize it and you call them, usually it's like you call somebody and be like, hey, dude, you owe us like for 2 months. You always let them have a month. So they run 2 months on you. And if it's a big customer, it's like 10% of your business. You're like, hey, this is hurting me now. And they owe you 2 months worth of stuff. So now you're in a position though where what are you going to do? Are you going to threaten them? Are you going to get a war with somebody who's 10% of your business? Are you going to let it slide? Are you going to cut them off? It's really hard to fix that when you're the supplier. That's why it's always dangerous to rely on big customers. And in businesses I owned, we would always watch our biggest 10. We'd always look at our top 10 customers. There's the old rule where 20% of your customers are 80% of your business. We would always watch our top 10 customers, and we would pay attention to how are they doing. It's not that hard. Once a month, somebody should be reviewing your top 10 customers to see how they're doing. Are they doing well? Is their business okay? Are they hiring? Are they firing? Have they moved offices? Do they look like they've got problems? You want to know that before it shows up on your balance sheet. And by doing that, you can run a much better operation. It's work that most people don't do when they own a business, but they really should. It's like you can't let your customers' financial problems surprise you. All right, so let's see how the market's doing. And the same goes, by the way, for investing, because if you're investing in somebody and you know who their biggest customers are and you understand their business, you should look to see the health of who they're serving. Otherwise, again, that becomes a problem. The people who supply Sears got hit hard. And Toys R Us, people like Mattel and Hasbro, right? They got taken down because Toys R Us went bankrupt. That hurt them. We all knew Toys R Us was going bankrupt, but did you think about that buying Mattel and Hasbro? Meanwhile, wow, what did happen? Did anything actually happen? Is anyone news? Anybody? Since IMAX is lower, should we double down? Not yet. Jeez, give it some time. It's like we're willing to double down, but we'd like to, but it would have to be significantly lower, and we'd still have to like the story for that to happen. Boy, this is a sharp little correction going on here. Oh, so what's the bottom line now? Did we fail at our bounce lines? That's the question, because this is what I wanted. With the key takeaway here is how did it perform from a bounce perspective and all. So let's refresh these. So I like about these charts is they're dynamic. All right. So again, we were looking for 25.3, and we're still above that line. So that's their strong bounce. The Dow's still way above their strong bounce. Nasdaq 6670. We got a failure right at the strong bounce on the Nasdaq. So 6670 was the thing. 6660. If this breaks, that's a bad sign for the Nasdaq. On the S&P 2748. So here on the S&P was the strong bounce line. It poked over, but fell right back below it, and now we're at 2748. We're basically at that line. So it's breaking below the strong bounce line, and the next one we look for is 44, which is going to be over here. And the Russell, we were looking for 1556, and that it blew. Oh, it's way over that. So the Russell is still way over there also. So still not that bad. Okay, nothing that's going on here is that bad. The key failure we'd be looking for here is on the Nasdaq. If 6666 fails, that's when they're going to have problems. So now, if you want to watch futures, you want to look for the 666 line on the Nasdaq, and it did fail right here. It already failed. So that indicates that people are going to go down. And here's the Nasdaq, Russell, and S&P. So now, who's lagging? The Dow is lagging. So if I'm going to short somebody to follow these down, I'm going to short the Dow because he's fallen the least, and so is the Russell actually. So who's got a better cross? The Russell has a better cross below 1560. So we can short the Russell. There you go. We'll short it. We'll go 2. It's too boring otherwise. All right. So now we've got 2 Russell shorts at just about 1560, and we want to keep tight stops over. What do we want to see for a? We want to see now. Now he's below 6650. So if he stays below 6650, that's a good sign. If he comes back below 25.3, that's a very good sign. And now we've got this 2745 line we can watch on the S&P also. So right now we're expecting this to go a bit lower, especially if we can get a little bit more out of these guys. Then what we want to watch out for is you want to watch out for the support over here on this green line. But you see how you make that decision process? You want to look for the best cross that's going to give you a good stop out that is confirmed by a lot of other indexes. You want to pick the one that's falling the least so far, and we can assume that these guys will come down to start matching. But meanwhile, we're worried about this guy bouncing right here and stopping the fall. Nobody else is in that kind of position, though. And you see that, and you can see right here, see the pink lines? They're pink lines. These guys are at their second green line. Second green line, first green line. He's barely in the middle of the pink line, and he's barely in the middle of the pink line. So these guys have a ways to go. But instead, they're bouncing. So here I'm down 65 bucks. So you want to pull the handle, you want to pull the plug if it's not going your way. These guys, he's back over 66.50. So basically, this trade is not working out. And we're going to kill it. Whoop, wait, that's only one. Uh-oh. Try and get that one off. All right. So bad trade, didn't work. So in other words, that so you pick the lines, but the point is to pick the lines that when it goes wrong. Like you could see it going wrong. 66.50 crossed over. This guy crossed back over. This guy crossed back over. Everyone crossed back over. That's a clear sign to get out. So this one didn't work. Lost $1,000. Okay. Now we wait and see what happens next. But that's the most important thing, is picking a spot where you can enter and get quickly out, take a small loss, and do it. Because when you get it right, if it actually fell down to 55, we would have made $500. So we risked $100 to make $500. So we could be wrong 4 times, be right on the 5th time, and still make a profit. But that's the trick, is you have to make those quick exits. If it doesn't go the way you expected it to, get the hell out. And again, we weren't watching the news. I don't know why that happened or what actually transpired. There probably some Fed guy said something, because it was pretty sudden. Let's see if I can go to Seeking Alpha and I can find like news or something. News. See if anybody particularly said something. Oops. Top news. See latest news. So I thought I was doing. Kohl's plans on leasing space to retailers. I thought they were a retailer. They're all doing that. All these big stores are cutting themselves up and selling off space. Boeing unveils electric cargo, Habitat restaurants, energy materials, Dish Day financials. I don't see anything really that would particularly move the market. So that was weird. See, generally things are bullish now, so there's no point in playing it. That's a shame. It would have been better off playing the bounce. But that's how you want to play the futures. So you want to find the best crosses, but the most important thing is to find one that has a good backstop you can play off. That's the real key to playing the futures, because you want to limit your losses. You're like on the Nasdaq this morning, we made, it's from yesterday. We made $11,000 on 15, so almost $1,000 a contract, versus losing $50 a contract here. So I'll take that every time. But so you have to be, you have to be in it to win it. You got to play, but you got to pick your spot. So it looked like we were going to start breaking down heavy into the close, but now we're being rescued as usual. And what time is it? It's so these things told me the time. I don't know. It's like 3 o'clock. Okay, yeah. So it's 3 o'clock. So it's unfortunately, if anything though, it's looking bullish, and you could play this thing north at the moment. But I'm not very enthusiastic about playing it bullish. But now it's looking like a better bullish setup because everybody's moving back up in unison. So still, it's the Russell because you want to pick whoever's got the best backstop for your entry, and the Russell is only 1 point down before you know you got to get out if it fails 1560. So I had my heart set on shorting though, so I'm not too thrilled about like jumping in on a long position. But if I were going to do anything based on what I see here, I would go long, hopefully at like 1560.5, and that way you can get a poke. And as long as these guys sustain green, as long as he's over 1560, you can stick with it and hopefully get a move up into the close. So officially, that would be the call at the moment. But again, my own personal feelings are I'm waiting for a shorting opportunity. I'm not really looking to find a long play, so I'm not so enthusiastic about taking a long, even though it does look like a good setup for it. Okay, what's that? So that's it. So we got to call it a day. 2 hours is plenty, and let's see what else. Last couple of comments, and we'll be out of here. I like selling put spreads on stocks. You suggest selling naked puts to get paid for watching. They cost less margin for those of us who don't have portfolios. Yep, that's true. If the stock moves against you, you have built-in profit. Just sell the lower leg, and you can use that to double down if you want. Yeah, but then you're back to your margin issue. So, yeah, I agree. Conceptually, I agree. But you can't have it both ways. If you're using it to solve the margin issue, you're creating it if you break the spread apart. But yeah, otherwise, I totally agree. It's a good way to play. Since we have plenty of margin in our portfolios, I prefer to play the naked puts generally. But that's just because we have the margin and we're willing to use it for that purpose. If we were tight for margin, we would not do that. But our style of play leaves us with a ton of cash and a ton of margin in the portfolios. Trump's going to announce pulling out of NAFTA. Oh, that'll be interesting. You think that's what moved the market? That is crazy. I mean, it's funny. It's good for some guys and bad for others, so you just have to see how it nets out. Oh, look, they came back. I'll be mad now if it starts going below, because that's why I stopped out. No, it doesn't look that weak, though. Yeah, you see he's back below 27.45. That's our break point on the S&P. Very annoying. So here we're just not getting good signals. I'd say no play is what I would say is probably the reality of this thing, because we're not getting strong signals either way. On the whole, though, it's kind of weak. Doesn't bode well for tomorrow. Ah, look at that, son of a bitch! I should have stick with him, right? Now down we go. At least we didn't get the longs. So yeah, I can't. I mean, honestly, it's going up, it's going down, it's drifting around. It's hard to say, but on the whole, the bottom line is from the bounce perspective. If you're failing your strong bounces, and you end up, especially if you fail a weak bounce into the close, it means you're probably going to follow through lower tomorrow. So let's see what happens. But don't forget, we're failing the strong bounces. That's not a good sign for tomorrow. And if they don't get back over the strong bounces tomorrow, what's tomorrow, like Thursday? So they don't get back over the strong bounces tomorrow, they'll maybe have one more chance on Friday, but otherwise, then probably want to go short into the weekend, because this can turn very ugly. I mean, it's been a long time since we had a good correction. Alrighty, so sorry we didn't have any particularly good plays here. This is a tricky setup, but we'll just have to watch it and see how it develops the next couple of days. Are you still in CL short? No, not in CL short anymore. And lost audio, Pat, don't worry about it because we're done. All right, guys. Are you still in CL short? No, because we did the RB shorts. We did the gasoline shorts, and that worked out. Took them off the table, and then it just wasn't worth playing anything else today. All right, guys. Thanks everybody for coming, and we will do it again next week. Okay, and please, if you have any comments on on audio or anything like that, like let Greg know for anything that's going on. Okay, because this is our first time using this new webinar system. We'll see how it comes out. All right, take care, folks. I'll talk to you again next week.